The global elites plan to take control of your money. And I believe they're going to do this through a central bank digital currency. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over the origin story of the Federal Reserve and how, if we understand how the Fed was created, and not just the Fed, but the first central bank in the United States, we can see how this may point directly to the central bank digital currency, or FedCoin, that Jerome Powell and a lot of other central bankers have been talking about. I'd like to point out the Fed was not the first central bank in the United States. The first central bank was called Bank of the United States. It was set up in 1791 by Alexander Hamilton. And if we dig in a little deeper and understand why this bank was set up and what Alexander Hamilton's intentions actually were, this sheds light on what the motives may be with today's FedCoin, or central bank digital currency. This central bank was offering loans directly into the real economy. It didn't have to go through the commercial banking system like the current day Federal Reserve. So hopefully right now you're connecting the dots and you see that a central bank digital currency would give today's Federal Reserve the power that Alexander Hamilton envisioned all the way back in 1791. Many of the mainstream economists today that really shaped the thinking for monetary policy implemented by global central bankers, people like Ben Bernanke, point to one idea in particular that led to the mistakes, or what they perceived to be mistakes, that the Fed made back at the beginning of the 1930s. It's something called real bills doctrine, or the real bills doctrine. It's very esoteric, but it's crucial we understand what this is to then lay out the probabilities for the Fed today, or other central bankers, adopting a central bank digital currency, which will give them control over your money. So to take a deep dive on the real bills doctrine, let's go right back to the internet. The real bills doctrine says that as long as bankers lend to businessmen only against the security or collateral of short-term 30, 60, or 90-day commercial paper representing claims to real goods in the process of production, the loans will be just sufficient to finance the production of goods. So what they're saying is that if a company needed short-term money, maybe for 30 or 60 days, to purchase widgets that they would use to produce a product and then sell, and once they sold that product into the real economy, then they could pay back the loan. Since the short-term increase in money supply would be used to facilitate productivity, you would never have to worry about consumer price inflation. So think about how far the pendulum has swung in the opposite direction, to the point today, especially going back to 2005 and 2006, you can get $1 million home loan if you can just barely spell your name and fog a mirror. It's unbelievable how far we have come in what I would argue is the wrong direction. Let's go back to the days, maybe not taking it to this extreme, but go back to the days where banks actually prioritized, and thought leaders, economists, prioritized sound money and price stability, meaning prices aren't going up or aren't going down. That the amount of lending or currency units, bank liabilities, dollars in existence should have one purpose, and that's to maximize productivity and the production of goods and services. So the main takeaways from step number 1 is Alexander Hamilton set up the first central bank in the United States with the objective of lending directly into the real economy. Something a central bank digital currency would give the current day Fed the power to do at will. Next is today's historians and a lot of economists believe that the Fed really lost control of the monetary system during the 1920s. The commercial banking system really took over, and they didn't understand the extent to which the economy was tied to the commercial banking system. Therefore, when we had the start of the Great Depression, the Fed made some policy errors due to this real bills doctrine belief system, which was applicable maybe prior to the 1920s, but in their minds, it wasn't applicable to the modern day economy. They believe this exacerbated the Great Depression and the deflation we saw during the 1930s, and it was all a result of the central bank losing control over the money system. In other words, they lost control over the dollar. Step number 2, the Fed completely loses control of the entire monetary system. But for step number 2, I want to illustrate how, starting with Bretton Woods in 1944, the dollar becoming the world reserve currency, the Fed and the domestic policy makers, the central planners, not only lost control of the domestic supply of dollars, but now they lose control over the international supply of dollars as well. So this is what happened. You guys all know how Triffin's paradox or Triffin's dilemma works. Basically, what it's saying is that in order for the global economy to grow at full capacity, it's going to need dollars if the dollar is the world reserve currency, and that's how business is done globally. As Jeff Snyder would say, there needs to be elasticity with the dollar supply, not only domestically, but internationally as well. And if you think through how dollars actually get outside of the United States, it's really by the US running a trade deficit, because we're importing goods, but yet we're exporting those dollars that the global economy can then use to facilitate maximum growth. But if there's not enough dollars getting outside of the United States, if we're not running large enough trade deficits, or in other words, if we're not hollowing out our manufacturing base enough, then it's going to be detrimental to global growth. So what happened in the 1960s is the economists really started to understand that there was this banking system that was sprung up in the shadows, the euro dollar system, that was supplying the globe with the dollars they need. Therefore, the United States, the Fed, and the central planners really didn't have to worry about it. They said, great, the free market is doing its job. It's supplying the amount of currency units or dollars it needs to function. This led them to a monetary policy that is summarized by the term benign neglect. So they just pretend that it really doesn't exist, and then they just try to micromanage the domestic banks, and they think that has a trickle down or trickle up effect to the euro dollar system itself. But in the back of their minds, they realize they've completely lost control over the dollar, especially when you compare it to the way it worked prior to World War I. And now the dollar-based monetary system was completely dependent on not only the domestic commercial banking system, but also the international commercial banking system. When you see things through that lens, it becomes crystal clear why whenever there's a problem with the banking system, the government or the Fed come in and immediately bail them out. They're not necessarily bailing out the banks. They're really bailing out the global dollar monetary system itself.